Hi, we're back again with another one. Now, we usually do a lot of talking about how to do stuff in Korea as a foreigner, or about what companies are in our market. Today, however, we're going to be in a different mood because we'll be taking a look at a report published by the Korea Development Institute, or KDI, that aims to look at the monthly economic trends within the ROK. You're watching Seki들, and this is where we stand in March of 2021. Now, before we continue, we'd like to remind you that this channel is meant for educational purposes only, and nothing said here should be considered or taken as replacement for legal or financial advice from a paid professional. Even for episodes like this, although we do our best to get our research right, it's always important to check sources and develop your own perspective on the topics that we discuss here on the channel. Also, if you like the kind of stuff that we've been making here recently, feel free to scroll down, hit the like and subscribe buttons, and we'll do our best to keep the content coming as we move through 2021. But enough of that, let's get to the guts. Alright, so based on the report provided by KDI, we've identified a couple of opposing themes that are sustaining and apparent over the first few months of the year, and also a continuation of trends that we've touched on in the past. Specifically, we're talking about the growth of industrial and manufacturing demand on the back of new product releases in both the semiconductor and automotive industries, which stands in stark contrast to the continued weakening of the labor market overall, led by prolonged stress to the high contact service industry due to COVID-related issues like lockdown and, well, COVID. To address the former point, there's actually a lot to celebrate regarding some of Korea's largest industrial sectors. For example, this past year has seen a boon in the shipping and shipbuilding sectors, in car sales, and semiconductor sales. Same goes for the stock market, which, although down from recent highs, is still very much in previously unprecedented territory. It's kind of wild to think that it wasn't even a whole year ago when analysts were worrying about the Kospi overheating when it was still at 2,400. Yet here we are comfortably treading water around 3K. Thus, it's not hard to make the argument that economic circumstances that arose from the coronavirus has and is continuing to benefit the main export industries of the Republic of Korea. By forcing everyone inside and taking away a lot of their alternative spending options, people have been making bigger purchases in the form of durable goods like cars, computers, and tech of all kinds. Now, these industries all grew over the course of January, with semiconductor growth just shy of 20% at 19.6%, and automobiles up 17.7%. On top of all that, telecom and broadcasting apparatuses are up 65.5% from December of last year. Also, some good news from the equipment and construction industry, as machinery and equipment investment has continued to grow, as has construction on a number of levels. Specifically, construction initiation, or the beginning of new construction projects, increased by 22% after already being up 60% the month before. Orders also increased to 10%, with the majority of construction focusing on the creation of new housing, offices, and stores. Similarly, in spite of reduced work hours on the manufacturing front, companies have picked up exports in the months of January and February, tagging along with the recent uptick in world trade volume. Good look for the economy, yeah? Well, kind of. See, while money funnels into those industries domestically, they're funneled out of consumer-facing retail, food, and tourism outlets, which, according to the KDI, has continued its prolonged slip, with the services sector continuing at shrinkage of 2%, led heavily by accommodations and food down 36.9%, and arts, sports, and recreation-related services down almost 50% from an already low point brought upon by social distancing measures. This is having adverse effects on the labor market, which has continued to plummet with a massive pickup in unemployment spurred on by large drops in the services sector. Specifically, the services sector took a nice nosedive from a loss of 622,000 employed persons to one of 914,000 between January and December. Manufacturing was down 110,000 jobs and continued to slide, albeit a little bit less, by 46,000 jobs. This bad news is exacerbated by the fact that consumer prices have seen a steep rise, with inflation growing from 0.6% to 1.1% over the course of February, as oil prices have progressively rebounded from the depths of the COVID recession, compounding with price hikes in agriculture, livestock, and fisheries products. Prices on the food front were exacerbated by poor harvest and an avian flu outbreak, while service prices, housing, rent, and purchasing prices have all increased, with only jeonse prices seeing a slight easing. But what does this all mean for us? Well, it all depends on where you are in the socioeconomic spectrum. By and large, offices, both public and private, have been able to retain workers, with many of the biggest companies turning to large growth over the course of the pandemic. Thus, with cash flows remaining regular or increasing, the rise in prices due to external factors may be felt only minimally. In any case, the stock market is still booming on the backs of the wild proliferation of retail investors seen since March of last year. Conversely, with rising prices, continued social distancing measures, and an ugly outlook for job growth in the service sector in the short term, this final leg of the pandemic, as vaccines are disseminated over the course of this year, may be an extremely trying one for many in or formerly in the service sector. Now, it's not like the government isn't aware of this though, and almost a month ago they declared a fifth stimulus package plan that included 8.1 billion won, designated to support small businesses and vulnerable populations. It'll be the second largest of the 5 stimuluses, and I'm sure it's causing a stir amongst many worried about inflationary effects of these stimuli, particularly when coupled with low interest rates and high rates of borrowing. But if the government isn't here to help people in emergency situations like this, then what is the function of being a republic in the first place? Still, with the rise of commodities prices forcing the issue with inflation, low interest rates helping it along, and continued stimulus pumping money into the system, it's difficult to imagine a situation where inflation doesn't become an issue. Unless, of course, you're MMT gang. If that's the case, as long as there's no material scarcity or fabricated price hikes, then there shouldn't be any reason to worry too much about hyperinflation as foretold by traditional economics. I'll leave some basic readings on MMT below if you want to figure out how to chill out in this type of climate, but in any case, here are the most important takeaways from this video. 1. Durables are selling like hotcakes both domestically and abroad, and both people and businesses with the ability to do so are taking out big loans to finance them. 2. The trends towards unemployment have yet to turn positive as job loss continues to grow on the back of super sluggish service sectors. And 3. If you're the type to worry about inflation, there's an extensive menu of reasons to set off the alarm bells going forward. The most important thing to remember, however, is that nobody can really tell the future, so there's no point in trying. Just understand what's going on around you and do your best to figure out what you want to do in a situation like this. Alright, this is a little bit different from the other stuff that we've been doing, so let us know how you like it in the comment section below. Also, sorry for the static, I think I need to upgrade my sound kit at this point. Take care, I'll see you guys soon, peace.